At a grocery store, a loaf of bread costs $3. Across the street, a cup of coffee costs 6. Online, a stock moves 10% in a day for no obvious reason. You didn't vote on any of this. You didn't agree to it. And yet you obey it every day. Prices tell you where to go, what to buy, what to delay, what to give up. And the strange part is this: there is no single person deciding them. We're told prices are set by the market. That sounds neutral, almost comforting, like gravity or weather. But the truth is more uncomfortable. Prices are signals, and the system sending those signals doesn't care about fairness. It cares about pressure. Right now, that system is under stress. And when it's stressed, prices behave strangely. That's why this matters now. Because prices aren't just numbers on tags, they're messages about scarcity, fear, power, and time. And once you understand how those messages are created, you start seeing the economy very differently. Let's strip this down to something simple. Imagine a small town with one bakery. Every morning, the baker makes 100 loaves of bread. People line up, some early, some late. If everyone gets bread easily, the price stays low. No drama, no tension. But one morning, something changes. More people show up than usual. The baker doesn't know why. Maybe rumors, maybe fear, maybe nothing. By noon, only 20 loaves are left. Now the baker has a choice: raise the price or sell out too fast. If the price stays the same, the first people buy extra. Latecomers get nothing. If the price rises, fewer people buy extra. The bread lasts longer. That price increase isn't greed in the cartoon villain sense. It's a signal. It's saying, something is scarce. That's the core idea behind how prices form. Not morality, not fairness, pressure. But here's where it gets interesting. In the real world, there isn't one baker. There are millions of producers, buyers, lenders, traders, and algorithms, all reacting to each other, constantly. Prices are the result of that reaction. No meetings, no master plan, just feedback loops. When demand quietly rises, prices slowly creep up. When fear spikes, prices jump. When confidence collapses, prices fall through the floor. This is why prices often feel irrational. Because they're not set by logic alone. They're set by expectations about the future, and expectations are emotional. Take oil. Oil prices don't just depend on how much oil exists today. They depend on what people think will happen next month. A rumor of war. A storm near a refinery. A comment from a central banker. None of these change today's supply, but they change tomorrow's expectations. And prices move in advance. This is why markets often look wrong in the moment, then obvious in hindsight. Prices are forward-looking guesses, not present-day facts. Now let's zoom out. Prices don't just decide what costs more, they decide what gets produced at all. If the price of lithium rises, companies mine more lithium. If the price of office space falls, buildings sit empty. If wages stagnate, certain jobs disappear. Prices act like a silent voting system. Every dollar spent is a vote. Every dollar withheld is a protest. But not all votes are equal. Here's the uncomfortable part. In theory, prices reflect collective choices. In practice, they reflect purchasing power. Someone with $10 votes once. Someone with 10 million votes constantly. This means prices often respond more to capital than to need. Luxury apartments get built faster than affordable housing. Speculative assets inflate faster than wages. Essential goods sometimes lag behind demand until crisis hits. This isn't a conspiracy. It's arithmetic. Now let's talk about the invisible hand everyone mentions, but rarely explains. The invisible hand is just shorthand for coordination without command. No one tells the economy what to do. Prices guide behavior indirectly. High prices pull resources in. Low prices push them out. That works surprisingly well for efficiency. But it has blind spots. The system doesn't see pain. It sees bids. If people can't afford rent, the system doesn't register suffering. It registers lower demand. And if demand falls, prices fall. But only after damage is done. This delay is why economic systems often feel cruel. They react. They don't care. Now add modern finance to this picture, because prices today aren't just shaped by people buying things to use them. They're shaped by people buying things to sell them later. Speculation amplifies signals. When traders expect prices to rise, they buy early. That buying pushes prices up now, which confirms the expectation. This feedback loop can inflate bubbles, housing, stocks, crypto, art. The object barely matters. What matters is belief. And belief moves faster than supply ever could. This is why prices sometimes detach from reality. Not because people are stupid, but because they're reacting to each other. Everyone is watching everyone else watch the price. Now introduce interest rates. Interest rates are the price of money itself. They quietly sit underneath everything. When rates are low, borrowing feels cheap. People take risks. Companies expand. Assets inflate. When rates rise, the mood changes. Debt becomes heavier. Projects stop making sense. Prices wobble. This is why a small change in interest rates can move entire markets. It's not about today's cost. It's about tomorrow's viability. If the future becomes more expensive, present prices must adjust. This is also why central banks have so much influence without setting prices directly. They don't tell you what a house should cost. They change the conditions under which buyers and sellers operate. The rest happens automatically. Now let's talk about something even more invisible: price stability. When prices change slowly, people stop noticing them. That stability creates trust. You don't think about money, you think with money. But when prices start moving fast, something psychological breaks. People rush, they hoard, they speculate, they panic. The signal becomes noise. This is why inflation isn't just an economic issue, it's a social one. Once people stop trusting prices, coordination fails. Shops can't plan. Workers can't budget. Long-term thinking collapses. The system that quietly guided behavior becomes chaotic. This is why governments fear inflation more than almost anything else. Not because prices rising is inherently evil, but because unstable prices destabilize society. Now here's the irony. We talk about free markets, as if prices are natural, but the system that decides prices is constantly being adjusted. Taxes, subsidies, regulations, trade rules, all nudge prices in certain directions. And sometimes, those nudges are deliberate distortions. Cheap fuel, cheap credit, cheap imports. Each creates short-term comfort and long-term consequences. Prices lie politely until they can't anymore. Then they correct brutally. This is why crises feel sudden. They aren't, they're delayed reactions. The system absorbs pressure quietly for years, then releases it all at once. Now zoom out even further. Globally, prices link countries together. The price of grain in one region affects political stability in another. The price of the dollar reshapes entire economies. The price of energy redraws alliances. No single authority controls this web, and yet everyone is bound by it. That's the invisible system, not a machine, not a mastermind, a constantly shifting network of incentives, expectations, and constraints. It works best when conditions are calm. It breaks when stress accumulates. And right now, stress is everywhere. Debt levels are high. Trust is fragile. Supply chains are stretched. Politics interferes with price signals. When prices stop reflecting reality, they stop guiding behavior correctly. That's when shortages appear in strange places. That's when excess builds where it shouldn't. That's when people start asking dangerous questions. Who decides what things cost? The uncomfortable answer is everyone and no one. Prices are the outcome of millions of small decisions colliding, filtered through power, money, fear, and time. They don't ask if the result makes sense. They just report the pressure. Once you see prices this way, you stop asking why something costs what it does. You start asking what pressure created it, and more importantly, what pressure is building now that prices haven't reflected yet. Because the system always speaks. The question is whether we understand the message before it gets loud.